Right, the vice squeezing Kiwi finances is about to tighten, with 60% of mortgages due to be refixed at higher interest rates in the coming months. Now, interest rates have risen dramatically in the past 3 years, from an average rate of just below 3%. Oh, the days, to around 7%. Now, a hike of that magnitude could, in some cases, add $400 a week to a mortgage bill. Even a jump of, say, just over 5%, the average in 2022, to over 7% can now cost some homeowners just under a couple of $100 a week extra. So what are there things we can do? Joining me now is mortgage broker Claire Williamson of My Mortgage. Good afternoon, Claire.
Hi, Leah. Thanks so much for having me this afternoon.
Lovely to talk to you. Gosh, even just remembering those halcyon unicorn days of 3-point-something% almost brought a tear to my eye. But it feels so long ago now. Claire, I would like to think that by now most people are off those, the fixed low mortgages by now with the 3 in front of it. But those yet to refix at today's rates are in for a huge jolt, aren't they?
Yeah, they are. I think probably the more organised of them have already been in touch with us. We've actually got a lot of people that are still rolling off those rates. Those people who got good advice 3 years ago and fixed for 3 years. But yeah, no, we're seeing quite a few people get in touch and just kind of ask us, what levers can we pull and is there anything we can do to kind of relieve the pressure of that increase? But I think largely most people are managing pretty well. Like, we're not getting anyone hugely surprised. So that's positive, I suppose. But It's all about managing that income and expense, I think, at the end of the day.
I suppose it depends. It's case by case. I understand that, depending on how big your mortgage is. But are you noticing people, they're banking on a drop in interest rates in the coming, even by the end of the year or next? So what is the best move, do you think? Is it trying to fix longer or shorter?
It's a really good question, and I think for me as an advisor, I'm always going to say it depends on your situation. But as a broad sort of from a broad perspective, I think sort of relatively short term is probably a good-ish bet. I think the thing I say to a lot of people is, are you going to get FOMO if you fix for 2 years today? Yes. And in a year's time, rates are lower. Yeah, and some people don't care. So it's actually... Yes, it's really good to know, though, to kind of, I ask that question. And if you say, yeah, I would, well, I go, well, cool. Well, in that case, maybe that shorter term fix might kind of suit you better. But although Claire, that
shorter term's normally higher, though, isn't it? There's your problem.
Yeah, it is. Yeah, totally. And you've got to weigh that up. And I think the most important thing from our perspective is to go, hey, actually, what do you care about most? Do you want the cheapest rate? Do you want the opportunity to get a cheaper rate, or do you want certainty? And a lot of people are actually looking at the actual rate itself and going, I want 6.39. Oh, okay, I need a fixed longer term. But that might not be the right option for them. So it's just, I suppose I'm a big advocate of advice.
No, absolutely. I mean, gosh, it's the biggest thing you'll ever pay off in your blooming life, so you got to try and get all the right things done in place if you can do it. So you were saying, though, that the people that you've spoken to, obviously you've given them fabulous advice and they're doing well. So you haven't heard or spoken to anyone that's in a real dilemma, like I might need to sell my home, Claire? You've had none of that?
Yeah. No, I have had a little bit, but I think what's really key for us is to go, what are the options, right? And so for some people, if they maybe paid a little bit more when rates were low, some people did do that. They might have a bit of a buffer depending on the loan product they've got. Sometimes we can pull a few strings to kind of extend the loan term a little bit, reduce the repayments, and like $50 a week, $100 a week, that makes a huge difference. That might be a third to half of a grocery bill. So, that makes a huge difference. So looking at that for some people, others, if they're under quite a bit of pressure, maybe interest only. We have a chat with the bank about that and their situation and kind of how long that's going to be. For some, it's refinancing, a better bank, a better loan product. Again, depends on the person. And then probably the other thing is a mortgage repayment holiday. So someone under a lot of pressure, but maybe having a bit of a light at the end of the tunnel, might be a new role, might be a change, might be someone coming back from maternity leave, etc. So yeah, those are some other things that we can do to kind of keep things burning.
Yeah, ticking over. I mean, because I was going to say, is there any point at all even talking to the bank about, what they could do? But is it, and you're going to say obviously because this is your business, but I would recommend to go to a mortgage advisor and that's your job, isn't it? You would do that talking, wouldn't you?
Yeah, and I think too, one of the benefits, I talked to someone today about this, is that we're across the board. So we have agencies in every bank. We know what's out there. We're literally every day talking to people about loans and interest rates and what's on offer. So some people just have no idea if their bank is offering them the best rate, the best deal for them. And so therefore coming to us, and also alongside that, getting some independent advice. Like they might want to sell and plan for that in the next 12 months. They might want to upgrade their property. They might want to renovate. They might want to buy a car. They might want to do a whole lot of things. They might have a change in role or something like that. So there's so many things that could affect your ability to repay your loan or make your mortgage payments every week. So it's about going what's right for you.
Yeah. You'll know this, I'm sure, from July 1, the banks are now limiting the amount of high debt to income lending. Do you think that's a good move? Will this make a difference?
Interestingly, I don't think it's going to make a difference at all until rates start to come down. So we actually did some numbers on this probably 3 months ago when there was a bit of there were mumblings and murmurings about it all happening. And actually,